new report says Morgan Stanley is calling the January swing the appetizer, not the main course for a broader market slide. Joining me right now to talk more about that is Mainstay Capital Management CEO and Chief Investment Strategist David Kudla. David, good to see you.
Good morning, Maria.
Do you think that's true? Do you think this is the beginning of something much bigger in terms of interest rates going higher? The 10-year yield has been up 6 of the last 7 weeks, and that there's more to come?
Well, I think we need to put the inflation scare into perspective. The read that we just had, the month-over-month number was 5%, but year-over-year, which is really what we look at, is 2.1%. And let's also keep in mind that central banks around the world have been trying to create inflation for years. We're just now starting to see it. So I think the fears of anything like 1970s, 7%, or 1980s, 5% inflation are far overblown right now. We're just now getting to the levels, the benchmarks that a lot of central banks want to see. It bears watching. It bears watching. We've seen interest rates come up. The 10-year Treasury yield has come up 0.5% in 2 months, from just under 2.5% to close to 3%.
Right.
That's a rapid rise. A further rapid rise in rates would be problematic for stocks, and it's certainly problematic for bonds. But I don't think we should be overly concerned with inflation yet.
So what are you doing right now in terms of when you see a market opening down 200? How do you deal with what is going to be a very volatile year?
Well, it is going to be a volatile year, and it's going to be a more volatile year than investors became accustomed to last year, where we never saw more than a 3% decline or drawback from a new high before the market rebounded and went higher. We had about a quarter of the volatility that we typically see last year. Now we're seeing normal volatility, maybe higher than normal. The last couple of weeks come into the market. So this is good for investors. It's a wake-up call that volatility to the downside as well as the upside still remains. And the important thing here is for investors to take a look at their portfolio now that they've had this gut check, if you will, the last 2 months. And is it really allocated in a way that they're comfortable with after maybe last year taking on more risk because of it felt like it was okay to do that. There was complacency in the market.
Well, David, what would you do? It's Dagan McDowell with a bond allocation here. Just in the next 3 days, we're talking about, in terms of supply of treasuries, about $250 billion. We're going to have record issuance on the 3-month and the 6-month treasury. You have 9 Fed speeches plus Fed minutes this week. And with that 10-year coming awfully close to 3%, what would you do with particularly your fixed income allocation in your portfolio?
Great question. And you're right. With the new issuance coming this week and the continued new issuance that will be coming, we have one of the big buyers of bonds, our own central bank, which is not buying bonds. We've gone from the flip side of that to where they are now letting their bonds run up the balance sheet. So we have issuance coming, a lot of demand. Here's what investors should do. Is look out for their treasuries, high-grade corporates that are interest rate sensitive, any interest rate sensitive securities. And we've been saying this on the show, for the past year, but it's really come to fore. We've seen it in the last couple of months. Look at a floating rate vehicle. BA Kellyn is an ETF that buys floating rate instruments where the yield adjusts as rates go higher.
Yeah.
So unlike bonds that suffer, the 10-year bond down 4% already this year, it's in positive territory.
Hey, David, Brian Brenberg, real briefly, talk about the opportunity in emerging markets. We're talking about that this morning. There seems to be something there that investors need to revisit. What are you looking at?
Well, as we look around the world and where we see growth now and compare that to valuations, valuations are high here in the U.S. We're at about 17.5 times on our price to earnings multiple on the S&P 500. We're richly valued here, but we think the U.S. market has further to go, even after this correction. But abroad, emerging markets have lower valuations, high growth rates, and real opportunity, especially with some of the commodities producers. We're seeing commodities start to strengthen. We're looking for global synchronized growth this year of 3.6%. A rising tide lifts all boats. Emerging markets that export a lot will do very well in that environment. So we're looking for a good year for emerging markets.
And U.S. stocks in general.
U.S. stocks in general. Let's remember that, with the fears of this recent correction, look at what the U.S. market has going for it.
Yeah.
We have 18% earnings forecasts for this year. We've had earnings guidance for the first quarter setting a new record high. We have GDP that's now running at 3% or greater compared to 2% in the first 7 or 8 years of the expansion. And we have tax reform. Tax reform, whether it comes in the form of share buybacks, dividends, payouts to workers, reinvestment in the business here in the U.S., that is going to be a bonanza. That is going to be a turbocharger for U.S. companies, the U.S. economy, and the U.S. stock market.
Yeah, we've been talking about that for a while. We agree there. David, good to see you, sir. Thanks so much.
Thank you, Maria.
David Kudla joining us there. Coming up.